Hey guys, this is going to be a look at ES on various time frames, starting on the log scale weekly chart over here. So just a reminder of where we are in time and space. We are outside the weekly channel for this bull market. We're ignoring this third wave excess that sort of rode the top of the channel for a while, and we're going with the original channel here that was established by these highs. Um, and if we zoom in, there are the top of the channel. There are three variations. This lowest level is the original channel. This line here is the SPX equivalent of the outer bound of its channel. And so these reactions here was when SPX was bouncing off the top of the outer bound of its channel, and this dashed line out here is the outer bound of the ES channel that includes that third wave excess. And I think this dashed line is the least important because it has the fewest reactions over time. I think these two are the lines to watch. Again, the lower one is the ES channel, and the top one is the SPX outer bound. So, uh, if we go back in history just very quickly, um, we see ES going above the channel, bouncing along the top of it, and then falling back below. And this first time, this is in the run up to 87, it peaked at about 8.5% outside of its established purple channel. Um, if we look in the run up to 2000, this first time out, first excursion outside of the weekly channel, it peaked at again about 8.5% outside the channel. It goes 8, 13, and 14. And in 1987, it goes 8, 13, and I think 19. So 8% and 13% are the first two peaks outside the channel, which is interesting because they're fib numbers. I can't attach a lot of importance to that, but it always catches my attention when fib numbers crop up. And so where are we now? We are depending on which variation of the channel we use. If we go with the SPX because that seems to be the one that acted as support, then this peak was about 8.4% outside the channel. So, none of this is predictive. This is simply establishing context for, in the past when we've hit 8.5% outside the channel, we tend to go back to the channel. And as we talked about in a prior video, this is the big 618 target of the yearly extension, 2000 to 2018 highs to highs. And we've dipped into this target now about 4.5%, which is what we dipped in at the lows, more or less. So if this wants to be an inflection point, there are definitely historical precedents for that. And, if we just remove the drawings for a minute, we have talked ad nauseum at this point about the series of weekly extensions. Right? It started on the daily chart, which I'm not going to get into. It traded three times on the daily, and then it morphed into the weekly, and we were trading highs to highs extensions to 618 targets. There was one, there was two, and then here was three. This is the most recent one. And you can see that we sort of front ran the target for a couple of weeks. We dipped in, we had a 40-point sell-off, we pushed in again, and we've had a major reaction. And in fact, if we go back, we've broken every variation of this next highs to highs. The most conservative draw, like this one down here, is drawing from the weekly close to the weekly close and then looking at the weekly close for support. And so this one is drawn from this weekly close to this one, and there's just no way around the fact that this weekly close broke the next extension in the series. So if we want to look at it on a line chart, there's the break. It did not, however, break this channel that we've been in. So, ideally this week we would print another candle that closes outside of that channel. So that's one feather in the bear's cap, but not both. The channel is technically not dead, which gives bulls something to hang on to. Um, and so after breaking the extension, we're looking for the immediate halfway back short, which is exactly the way it worked in the September sell-off. Right? We broke the less conservative highs to highs extension, and then they traded the halfway back short. Yes, it dipped into the 618, but it did trade. There was a back test of a broken support line right there. So, note that these wicks here create a potential stealth support line right here outside the channel. And so, in fact, if we go to the daily chart now, is this everything I want to say about the weekly? I think so. So if we fall out of this channel, the next potential support is not a fib level support. That trend would be over. It would be the top, probably the top of the SPX channel, or this one down here. Consider this a zone. So if we go to the daily chart now, again, we broke it. You draw up the next halfway back short, and I'm hesitant to just short at a 50% short on a large time frame like this unless there are other reasons to take the trade. And in this case, a great reason was the daily 8 EMA being right here as well. I mean, if you just go back and look at recent history, I'm convinced that on all time frames there are algos attached to the 8 EMA. That's the 5-minute, the hour, the daily. And so if you just go back, for example, these over the summer, we would sell off below the 8 EMA and then we'd snap back and close immediately above it and then ride it. Snap back, close on it or just above it, and then ride it. Contrast that with the sell-off in September where we sold off below it, and then here, resistance, 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 5 days of resistance selling off. Here there was a reaction to it. I don't know if you can see that. A reaction to it, it tried to act as support and failed, and then resistance, 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 resistance. There was a close above, and then it tried to hold above. So anyway, the point is we want to see the 8 EMA continue to act as resistance here against this halfway back short. If we start closing, getting a daily close above the 8 EMA, that could be a sign of trouble for bearish scenarios. So, I would not be surprised if intraday they want to fill the gap. Today we did a half gap fill of the gap that was above us, and they want to dip into the 618 retracement and trade a deeper fib level like the 786, which is up around the 4700 level. That wouldn't surprise me, but bears don't want to see daily candles closing above the 8. If you just look at recent history, that's a bad sign for bearish outcomes. What else? Is that everything on the daily chart? I think so. So if we go to the, briefly on the this chart. So during this recent sell-off, the top of this channel that was established by these 3 points, and there was a reaction at the 4th before it flipped to support. There are about 15 2-hour candles that touch the top of this channel. So it was probably the most well-defined support line in history. And then when we broke it, I think this was Thanksgiving Eve, right? There was one single back test that was the entry into this short. And my computer was up and running. I looked at it around here and I didn't take the trade. I saw the back test because on the tick chart, there was just no volume, and I don't like shorting a market with no volume. It turns out that the algos didn't care and they sold it hard anyway. Um, I was thinking that they might ride along it until this week and then have a sell off and maybe even make a new high on even a greater divergence back testing this line. But in the event, none of that happened. That was the opportunity right there. So if we go to the 2 hour chart here, so again, the linear chart has this resistance line here that's been a sell point multiple instances over the past year or longer. Um, and so, here is the weekly 618 target that I put on the 2 hour chart. And you can see the first time we pushed into it, there was an immediate 40-point sell-off. So that is a reaction. Then we came back, we squeezed out anyone who had tried to get short in the previous 3 weeks, and then we sold off in what is a very clean 5-wave move. 1, 2, 3, 4, 5, A, B, C up. 1, 2, 3, 4, 5. And so, actually, let's go to the hour chart. This is an example of how Elliott wave teaches you to think, right? 1, 2, 3, 4, 5, A, B, C. 1, 2, 3, 4, 5. The question is, this fourth wave and this fifth wave, to what degree of trend do they belong? Are they a fourth and a fifth that goes with this 1 and 2 up here, making this a complete 1, 2, 3, 4, 5 wave structure? Or is it a fourth and a fifth wave of this wave right here? Which means this would be a 1 and a 2 and a 3, but we were still looking for a 4 and a 5 down. If this was only 3 waves down, then a wave 4 could not overlap the bottom of wave 1. And you can see this morning at the open, we had sellers against that pivot right there. It dipped 1 point into that level and got rejected. And we've since penetrated into this zone. So there's 2 scenarios here. Scenario number 1, this is a complete 5-wave structure down. 1, 2, 3, 4, 5. And we're working on maybe an ABC, which can extend all the way up to close this gap. Maybe trade a 786 retracement of this full move, and maybe spike this potential downward sloping trend line here. So this zone up here around 4700 could be a sell zone. That's scenario number 1. Scenario number 2 is that this was simply an A, B, C correction and the move is over. And that seasonality is going to take control. I don't like the term Santa Claus rally, and we saw over Thanksgiving that the market doesn't give a flying F about holidays. But seasonality predicts that the market will rally for the rest of the year. And that's despite the broken weekly extension, which is definitely broken. So is that everything I wanted to talk about on this chart? Yeah, so on the way down, we've had some corrections that go a 618 retracement to a 618 target, and we've had other corrections that go from a 38.2 retracement to a 618 target. So on the way up, this is a 38.2 retracement, and the 618 target is again at 46.99. So there's a zone of reasons to maybe sell into 4700 if we get there. Meaning this could be a complete ABC correction. We would fill the gap. We'd spike the downtrend here. There's a 786 line up there. Just depending on everything else going on in the market. But again, back on the daily charts, watch the daily 8 EMA. Ideally, we'd get an intraday spike up there, but not any closes. And that's all I have time for.